Welcome back to the Apartment Dealer Show. Today we're going to discuss the first of the three pillars of building one's financial legacy. Anytime I reference what you and I are doing when we're purchasing multifamily properties, I reference that we're building a financial legacy for ourselves, for our family, for our heirs, for the future. In building that financial legacy, I see it as there being three foundational pillars. The first pillar is maximization. And I would equate this to getting your financial household in order. What do I mean? With the current investment properties that you own, how do we increase our net income? Because at the end of the day, name of the game is cash flow. And how do we increase the property's value from within? Why do we want to do that? So that we can then transition to pillar 2, which is growth. Growth being more units, more cash flow, and the compound effect that comes with that. And then the third pillar is preparing for tomorrow. This is when we begin to contemplate exiting real estate. What are the strategies to do so while mitigating our capital gains exposure, as well as considering the next generation behind us, those that we may leave our properties to in the future. Now, as we go through this 3-part series, I want you to consume the content thinking of what pillar am I in, or what pillar should I be in, and really consume the content through that filter. So let's discuss pillar 1, maximization. So the first question is, why? Why should I work on my current properties? Given all the recent legislation here in California, given rent control, just given the difficulties when it comes to owning multifamily property, I would say that's exactly why you want to maximize your profits and maximize your property's value. Look, yes, there is rent control here in the entire state of California. And some of us have a rougher batch of this. Some of us are governed by only a 3% annual increase, some 5%, some 5% plus CPI. And who knows when you're watching this if that's all been changed depending on where you own. But the point is that given the risk involved of owning multifamily property, and yes, it has got more difficult, shouldn't we earn a greater rate of return for our risk? Shouldn't we do things to improve our property's value so that in the future there's that much more equity for us to capitalize on? So with respect to rent control, whether you can currently raise your rents by 3%, 5%, the question is, what if you can leapfrog that? There's, within the rent control law, now speaking to AB 1482, there's a provision of which if you do capital improvements, you can actually still ask tenants to vacate your units. And when we're looking at this, we have to take a look at what's the current tenant paying in terms of monthly rent. What do we see as the potential market rent? And given our discussion here on capital improvements today, oftentimes we're getting 5, 10, 15% even above high market value in terms of the rents we're able to collect once we do the right type of capital improvements. But the bottom line is, let's say you can increase where you own currently by 5% annually. But what if you could increase that rate of return, say, by 15%? See, that's the question here. And it really is an analysis of what are you currently collecting? What's the potential? How much does it cost to get you from where you currently are to market in terms of the improvement of the unit? So we're talking about net income, property value. Now, yes, we all start in pillar 1, maximization. Okay, we have to build the value of our properties from within. Why? Because we're going to do one of two things eventually. We're either going to cash out, do a refinance and take some cash out so that we can move into pillar 2 and buy additional property so that we can have that many more units to our portfolio, which only lends itself to having that much more net income. In that scenario, cash out refi, maybe based upon today's standards, you take, say, 65% of your building's value and are able to roll it over. If you were to sell your current property and do a 1031 exchange into pillar 2, now you have 100% of your equity working for you. In either case, the idea is we want to increase the number of units we own if it truly, in fact, increases our net income, and that gets us down the road to the compound effect of pillar 2. Third reason, tax deductions, right? We need to mitigate our tax exposure as much as possible. Well, of course, with capital improvements, that adds to what we can depreciate over time. Now, when it comes to condition of property, by now I've sold over 300 multifamily properties on behalf of clients. My wife and I own our own properties ourselves. I've seen many, many buildings. And more times than not, upon doing an inspection, we walk into a rental unit and you walk into the living room and there's one type of tile. You turn into a bedroom, there's another type of tile. You go into the bathroom, there's a really interesting choice of tile there. You go into the kitchen, yet another type of flooring because that one was on sale at Home Depot. You take a look at the kitchen and it's the old 1960s cabinets, and all the owner has done is maybe painted over them. And maybe there's one, if you're lucky, one new cabinet on this side of the wall just because that one broke. And some people call that a day in terms of, hey, technically I have tile floors or I have wood laminate floors. Technically I tiled my bathroom. Technically I've updated the kitchen, and I'm not here to knock anyone's way of management. All I'm suggesting is there's a better way so that you can obtain a different type of tenant that can pay you substantially more money, and so that you can increase your property's value. So you say, Chris, but how? How do we do that? We have rent control here locally. As I mentioned, within the rent control bill, they did allow landlords, if you do substantial improvements, and we'll put the verbiage here, you have to check a couple boxes here. Number one, it has to be a substantial improvement. Putting new cabinets in the kitchen does not count for substantial improvements, I'm sorry to say. It's things like electrical, plumbing, and they even notate those specific items in the bill itself. Second, the improvements that you're going to do would have to cause you to pull permits in order to do the work. Third box, the work must take, or I guess look to take, more than 30 days. Check those three boxes. You can give your tenant, and now check your local city, but in most cities, you can give your tenant a 60-day notice to vacate. They have to go on their way, and now you've taken possession of the unit. Now, before just doing this, of course, it goes back to the analysis. What's my current rent? What can I get for market? How much more above market can I get, depending on certain improvements that I'm pondering. Now, you can go to our YouTube channel. I've actually shared videos of my own personal properties so that you get an idea of what it is we're doing in our own units, what type of materials are we using, finished materials. We've even done full financial analysis in terms of what's the final outcome in terms of the rental income, just to show you real life, how do you apply this provision within the law? How does it apply to you? What, if any, difference would it make within your properties that you hold now? And we're going to link to those specific videos down in the description. Now, let's say you had the choice between two tenants, and we'll call them tenant A and tenant B. Tenant A chooses to be a single individual. They put marriage off till further down the road, versus tenant B get married earlier in life, begin to have children earlier in life. Tenant A maybe cohabitates with another individual, both of whom are working. No marriage, no ties, no children, but you have two working individuals. Tenant B oftentimes is a one-income household. And as I mentioned before, they have a family. There's more expenses that come along with that. Real kicker, tenant A sees home ownership as a liability. They choose to be a renter, but in choosing to be a renter, they want a nice location because they can afford a nice location because you have two incomes, no children many times. Versus tenant B, they want that American dream. They want to own their own home. They understand the value of home ownership, so they're saving every penny, and they're willing to live in an inferior unit so that they can save that much more money to put towards their down payment for a home. As a landlord, who would you choose as your tenant? Who has more discretionary income to use to pay rent? It's tenant A. So let me introduce you to the millennial. The millennial is the largest part of the US population today. These individuals now are in their late 20s up to their late 30s. They fit the profile as I just discussed, and they're willing to spend more than 50% of their discretionary income on rent so long as you have the right amenities. So let's talk improvements. Now, what you're looking at now is a photo of a property that my wife and I own, and you'll see what condition it was when we purchased the property. That was the previous landlord's idea of a rental unit, I guess. Some people allow their tenants to live like that. We choose not to. Why? Because I knew if we did the right type of capital improvements, we'd get a different type of tenant and a significantly higher rent. Let's say I would have left the unit in its previous condition. Given the community it's located, maybe I would have been able to collect $900 to $1,000. We did the capital improvements as you see, which included new plumbing, electrical, windows, kitchen, bathroom, flooring, paint, recessed lighting, the whole nine. And we collect about $1,400 today. There's a significant difference, 40% more in rental income. And the tenant that I have is, guess who? It's a millennial, no kids, not married, 2 incomes. Now, of course, we open our units to everyone, but the individuals who are willing to pay the $1,400 typically fits the profile of a millennial. Now, the second property that we're going to discuss is a 4-unit property that my wife and I bought towards the end of last year, just recently sold it. Now, we again made the right capital improvements that I knew that would push the needle in terms of property value and rental rates. We placed a couple new tenants in the units, even though this is in the unincorporated area of LA County, which now has a version of rent control that's very similar to LA City. But we work with the tenants. We were able to, of the 4 units, place 2 new tenants, do capital improvements in those 2 units, new plumbing, electrical, windows, kitchens, bathrooms. It's always the same picture of what we do. Exterior stucco, windows, and the other 2 remaining units where the existing tenants still chose to stay, the 2 tenants that were already there when I purchased it. We did the windows there, stucco. Here's the bottom line. So let's look at some math. In preparation of today's video, I pulled comps. I took a look at the historical for 4-unit properties in this particular geographic location. The highest priced 4-unit property that had sold prior to mine was $800,000. Ours closed escrow at $920,000. Now here's the real kicker. In terms of price per square foot, the highest price prior to ours was $289 per square foot. Ours, $425 per square foot. So you can see the differential. Again, maximizing what we own. Had we chosen to hold the property, 2 of the 4 units, we totally renovated, push rents way above market. If we chose to sell, we get well above market value in terms of the asset itself. Why? Because the next buyer behind me finds the value. Hey, copper plumbing, new wiring, sub panels, stucco, concrete driveway, windows. There's not going to be much for them to do in the foreseeable future. So for them, it's an investment today versus having a property that's going to nickel and dime them with leaks and galvanized plumbing and drainage issues and all these type of things. So for the buyer, they're investing for the years to come in terms of less maintenance and so forth. For us, we did the improvements today so that we would have that much more capital as we take this capital now and move it into pillar 2, which will be growth and expanding in terms of the size of our portfolio, number of units. Why? For cash flow. The third property I want to share with you is we're actually going to share some footage from our last live educational event that we hosted for landlords like you. And at that time, we had just opened escrow on this particular property. Flash forward, today we now have that property in escrow. But let's first take a look at how that deal started out. This is a property that I just purchased in Ontario. Now, my escrow is going on while this rent control thing is heating up. This is a 5-unit property, and the tenants, if you can believe it or not, were paying $750 and $800 per unit. The woman who sold the building actually built the building with her husband, and they had owned it since the 1960s, and apparently never raised rent. How that hurt her, I didn't represent her. I bought that from an agent. It was on the open market. Maybe some of you saw this deal just a couple months ago. I ended up buying it, 5 units, all 2-bedroom, 1 bath, single story, good size units, big backyards, $760,000. Good buy. That woman the seller, who was elderly and retired, and she was selling and riding off into the sunset, would have obtained at least another $150,000 for the sale of her building had she had the right rents in place. I wouldn't have been the buyer at that point, but somebody would, knowing values in the area, somebody would have. Now, so I mentioned I'm in the middle of rent control while this is going on. To understand how this works, if I would have gave the tenants a notice to increase rent when I took over in September and August, the rent control bill has a rollback feature, meaning whatever your rents were in March 15th, everyone in this room gets to take their rents back to what they were on March 15th if your last rent increase was more than the proposed rent cap. You follow? So if your tenant was paying $1,000 on March 14th and you gave them a $100 rent increase, that's 10% on March 16th, you get to go back to $1,000 come this January 1st of the new year. That's how the rent control bill works. So my escrow, $750. Even if I would have worked something out with them to say, hey, let's agree on $1,100. Market is $16. Let's agree at $1,100, which is what I would have done. It becomes law. Now my rents would have went back to $750. Can you imagine raising rents 7% on $750 once per year for the coming years? Makes no financial sense. So the government forced my hand. I gave everyone a 60-day notice to vacate. All tenants. 4 of the 5 will be out come this Monday, and we're going to start our construction. And we'll do the same type of rehab that we've done. Now, to sweeten the deal, Stephen Hall assisted me in purchasing this property in an investment trust where my money that sits there in the trust is non-taxable. The growth in the property is non-taxable. I put my rents into this account and they're non-taxable. This is why we bring people like Stephen Hall. For the financing, now, any bank was not going to lend me a traditional loan, even 50%, even a 40% loan to value, given the rents. Bruce Norris and his firm has a loan program. They lent me more than 76% of the value at purchase. And so you understand now, my leverage, I maybe put 24% down. It goes in an investment account. We're going to do the major capital improvements, bring them up to market. That's the idea when we say maximization. So now, where are we today? That property is actually in escrow to sell. And assuming we close escrow, buyer has already removed all contingencies, so we assume there's no reason why we won't hit the finish line. It will be, if not the highest, one of the highest priced sales on a per unit basis that we've seen in the entire city. Why? Again, if you're the buyer, new electrical, plumbing, again, I don't want to beat a dead horse. You get the idea. They walk in these units and literally, I've never seen rental units like this. What type of landlord takes care of their property like this? Some of the finishing materials and those bathrooms, one of us might use in our home. So we splurge a little bit. Why? Because our property becomes a tiebreaker. This buyer, who I'm not representing, if they're looking at 3, 4, 5 properties out there, I can tell you all the other properties they're looking at were cheaper than our asking price. But as they do inspections and they see the deferred maintenance and they take a look at the rent roll, the rents are 20, 30% below market versus our property where literally everything has been done on that property other than the roof, which is still in good shape. And the rents are above market value. So keeping in mind rent control, as they take ownership and continue to raise rents in the years to come, the size, whether the state chooses it to be 5% or 3%, right? Nonetheless, they're starting at a higher rate, and every year going forward, they're that much further ahead of the game. And if and when they choose to sell, that property for them becomes a tiebreaker. And we've moved on to pillar 2 at that point. So pillar 1, maximization, increasing the value of the property from within. Why? Net income, more capital, more equity, tax savings, to get to the real goal, which is then to transition to pillar 2, which is growth. I hope this helps. Please share a comment below, like the video, share this video with other landlords that you know. We're trying to lock arms with other investors like you to share a little bit of our story, share what we're doing on behalf of our clients. I can't tell you how many calls I get from personal clients saying, hey, Chris, based upon your videos, I've made these improvements. I can't believe my rent's shot to this much. That's the idea. We want to work alongside you, the investor. Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and now more than ever, much protection from Uncle Sam. Till next time.